Innovative Finance at the United Nations Development Program. Let me start out by acknowledging that this event is jointly hosted by UNDP and our partners in this effort. The 2030 Water Resources Group hosted at the World Bank and represented by Kavita, the Impact Investors Council, and we have Ramraj here from IIC, and Nishit Desai Associates, and we'll be hearing from Mayappan during the course of the proceedings this afternoon. I also just want to take a moment to provide a little bit of context on why we made this effort. For a number of years, I think a lot of us that are part of the panels today, and hopefully also listening in, have spoken about various financing instruments and structures. And that during the pandemic last year, we also interacted with a number of institutions and organizations who were working towards mobilizing capital, not just in the form of immediate relief, which, for medical supplies or PPEs, which is traditionally done as grants and perhaps in some cases much more straightforward, but also organizations and institutions that were working on structures and deals that catered to a recovery and to a longer term effort. And while a significant amount of capital has, of course, been deployed by the government of India and by various state governments, the extent and impact due to COVID-19 demands tapping into additional sources of finance. And there's a view certainly shared by all of us here today that commercial mainstream capital can also come in to fill this sort of funding gap, provided that opportunities are appropriately structured and the risk return profile is also somewhat aligned. Grants and grant capital, which is fairly scarce in India, for all the talk of blended financing and so on, grant capital in India or de-risking capital is still fairly scarce. And so there is an opportunity for us to use grants in more innovative ways so that it can also contribute to the achievement of social and development outcomes. And therefore, in some way, also bring in commercial capital. The solutions that are presented as part of the white paper or report that we're going to share this afternoon outline examples in sectors such as MSMEs, livelihoods, and agriculture. But of course, as financing structures could be applied across a range of sectors and solutions. We're looking at a few distinct models. We're looking at guarantee models. We're looking at outcome funding models or impact bonds that have also been covered extensively in the recommendations for the Social Stock Exchange, which also released, SEBI also came out with the technical paper just a week or so ago. So as you go through this report, you'll notice that we've made the effort to highlight financial flows at different levels and between different parties and intermediaries, and really used a red light system, if you will, to highlight financing flows which are perhaps not feasible given the current regulatory regime, financing flows where more clarity is required, and of course flows which are currently possible. So as I said at the start, this effort is not focused on immediate relief, but rather how we can galvanize additional resources over the medium term. So we're going to delve deeper into these areas and the findings of the report over the course of the next 2 hours or so. So let me just start out and give you a quick overview of the proceedings this afternoon. We have a keynote, and we are absolutely honored and delighted to have Mr. Amarjeet Singh, Executive Director of the Securities and Exchange Board of India, who'll start us out with the keynote and some overarching reflections. This will be followed by a presentation by Nishit Desai Associates outlining the contours and the findings of the report. And then we have an exciting panel discussion that covers government, covers philanthropy, covers private sector. And we have Amit Chandra. Mr. Chandra is the chairman of Bain Capital and a leading philanthropist in his own right. We have Mr. Ajit Pai, who's a distinguished expert at Niti Aayog, where he heads economics and finance. and oversees public investment, disinvestment. We have Mr. Prabhat Pani, Senior Advisor at the Tata Trust, also dual-hatted because he's also working or strongly engaged with the SP Jain Institute of Management, where he heads the postgraduate program on development management. And of course, we have the moderator, Geeta Goyal, and Geeta is the country director for the Michael and Susan Dell Foundation, has a lot of experience with the sorts of structures and the sorts of roadblocks that we really try and cover as part of the report this afternoon. So to start us off, please allow me to welcome and introduce Mr. Amarjeet Singh, Executive Director at SEBI, where he has, over the last 25 years, of course, gained extensive experience in regulation and supervision of the securities markets. He's been on various boards and committees, including with the Reserve Bank, the Ministry of Corporate Affairs, been spearheading the work within SEBI on the social stock exchange. And of course, his team is also engaged with us on the Sustainable Finance Task Force, which has been instituted by the Ministry of Finance. And we've been working very closely with his team on aspects there as well. So Mr. Singh, thank you for joining us, and we look forward to your keynote. So I'll just hand over to you.
Thank you. Thank you for that kind introduction. Good afternoon, everyone. It's indeed a pleasure to be a part of this event. So my hearty congratulations to begin with to the team who has worked on putting this together. The report on innovative finance, which is being released today, is a very timely and relevant initiative to my mind. And I would like to heartily compliment UNDP, Nishit Desai Associates, Impact Investors Council, and 2030 Water Resources Group of the World Bank for collaborating and delivering this important report. So, I had a chance to browse through the report. I have not read each and every line, but I got a broader sense. So this report is an attempt to reimagine, that's what the title says, reimagine traditional finance. And I thought it interestingly intersects with SEBI's ongoing work on setting up a social stock exchange. Earlier this month, we released the second report on setting up social stock exchange for public consultation. So, to my mind, I think there is a need for a greater public discourse on innovative financial structures, particularly relevant for developing country like ours, where supply of long-term patient capital is never adequate. The ongoing devastating pandemic and also the associated recent surge in global concerns on ESG issues are very sharply redefining development needs, development strategies, and development priorities. This in turn has important implications for the world of finance. So let me briefly mention what I perceive as what are the implications for the world of finance. So to my mind, I think we need to reassess the quantum of development capital required for development in the coming years in the context of what is happening today. Revisit the allocation of capital. I think that's another very important piece. Rethink whether the current structures and instruments are adequate, whether these current structures are delivering for the purpose of raising of capital. And an associated point, are the existing disclosure and the reporting structures, are they also adequate or not? I think these are some very important issues which all of us who are in this ecosystem need to reflect upon. So I think in my address, what I would like to do is I'll touch upon each of these elements and perhaps spend more time on the innovative instruments as the topic of this report also is. So let me begin with the quantum of capital. So, you're all experts and you already know this. So just bear with me for repetition. India has committed to achieve the UN Sustainable Development Goals, SDGs, by 2030. NITI Aayog, in its voluntary national review published in 2020, has noted that India needs to increase its SDG spending by an additional 6.2% of its GDP until 2030 in order to meet goals and targets set under the SDG framework. Another important data point, which I thought is relevant is our current ranking in the Human Development Index. So what I checked and I found it is 131. Actually, it has deteriorated from 129 in the previous year. It has become 131 this year amongst 189 countries. So the short point is we have a long way to go when it comes to development. We have miles to go. And the question is, are the government spending and the conventional financial capital enough to meet our goal? Obviously not. We need financial capital from all sources, private, social, philanthropic, whatever you want to call it, and we need loads of it. So I mean, let's leave it at that we need tremendous amount of development capital. Now let me talk briefly about allocation of capital. So suffice to say that the needle is moving fast towards greater sustainable investing. Sustainable or ESG investing is no longer a mere fashionable topic for seminars, as it used to be a few years back. So needle has definitely moved on a more serious note. While legislative and regulatory push will continue to evolve, market forces have already been playing out to drive the change. You look at investment trends in Europe in particular, and you'll find that a lot of investment is driven by how much the investee companies are engaged in ESG issues. COVID-19 has set the stage for further boost to sustainable investing. It will trigger, I think it has already triggered, fresh thinking on allocation of capital, not just by companies, but also by governments and investors. So let me move to the third strand, and there I would like to spend a little more time. That is the innovative structures and financial instruments. So again, before talking specifically about the innovative structures and instruments for capital raising, let me digress a little and make note of some important debates and shifts taking place globally, just to set the context. I'm sure you've heard about this again, but just to sort of make note of, these are important sort of mega trends as I see it. There's a debate about the purpose of companies, beyond profit making. There's a debate on shift from maximization of shareholders' interest to stakeholders' interest. And there's it is widely accepted that the impact returns or the social returns are as important as financial returns. So call for such shifts is only getting louder in the COVID times. So it is in this context that we need to evaluate the efficacy of existing financing and reporting structures and explore new avenues to attract private and philanthropic capital for development purposes. I'm happy to note that the report being released today looks at adapting blended financing principles in the Indian context, and that's very important, and lays out several actionable solutions that leverage philanthropic funds to attract commercial capital. I noticed that there are a number of at least 3 case studies which are referred in the report. SEBI's ongoing work on social stock exchange is another attempt in this direction. While a stock exchange is conventionally perceived to be a capitalistic institution, social stock exchange is an interesting novel concept. Again, this is a shift, again, a paradigm sort of shift, which is happening world over. In my view, it has the idea of creating a social stock exchange has tremendous potential. Creation of social stock exchange is aimed at unlocking private capital for social enterprises, comprising of both non-profits and for-profit entities. Social stock exchange would bring more visibility to the social impact that social enterprises create. But I'll talk about that more in a minute. Since this work has just been released, the first report, of course, has been in public domain for a while and people are familiar, but the second report, which was released recently. So let me spend a couple of minutes, about the recommendations on the innovative financial structures, and I'm combining both the reports together. In fact, I'm happy to see Mr. Amit Chandra also there, and he was a part of the first working group. So there are essentially 4 suggestions on the new instruments, 4 main broad suggestions, apart from others. So one is on social impact funds, development impact bonds, zero coupon, zero principal bonds, and donations through mutual fund route. Let me spend a quick minute on each of these 4 instruments. So social venture fund were enabled by SEBI. I think SEBI was in some sense ahead of its time. This goes back 9 years. Our AIF regulations came in 2012, and as a part of our AIF structure, social venture fund was identified as a category of funds. But somehow, it has failed. I won't say failed, but it has not got enough traction for various reasons. I'll not go into those at this point in time. So the fact is that this is a 9-month-old vehicle which has been available. 14 SVFs are registered with SEBI, and total funds raised by them amount to rupees 1,900 crore approx as of 31st March this year. So the technical group has gone into details, and they have suggested complete recasting of this vehicle. And for details, I would suggest you could check in the report. Let me move to the second vehicle in the interest of time, mutual fund mechanisms. I think these are again vehicles which provide a unique opportunity to raise capital for non-profit social enterprises. We have 2 well-known examples. One is the HDFC Cancer Cure Fund, where the investors can choose to donate the interest income from their investments, either fully or partially, to the Indian Cancer Society. Another example is that of Quantum Mutual Fund's Smile facility, which enables investors to redeem part of their units for donation to NGOs, which are registered and monitored by Help Your NGO Foundation. I am personally quite fascinated by this instrument because it is very simple to understand, and it enables retail investors who are investing in the mutual fund space to choose to donate part of their returns with some confidence. So I think we need more of such schemes from the mutual fund industry, and that's what the technical group has also emphasized upon. And there is no regulatory tweaking required for this. It's already happening. It's very simple. People just need to launch. Mutual fund industry just needs to launch such schemes. Turning to development impact bonds. So the first 2, social venture fund, mutual funds, they are already there. Social venture fund, we need to rehash. Mutual funds already existing. On the DIBs, I think this is really something very, very interesting. This presents a huge opportunity to channelize investors' need to fund credible social projects. And DIBs within the securities market domain can be activated using vehicles such as alternative investment fund, social venture funds, etc. So I would again request you to please take a look at the report as to how DIB structure can dovetail into the securities market ecosystem and how this can be taken to a different scale altogether. I think it has a lot of potential to my mind. Finally, zero coupon, zero principal. These are bonds, but these are essentially donations. And we've tried to create a new structure there for non-profits for specific social development projects and activities. Bonds will have a zero coupon and no principal payment at maturity. But again, this is still on the drawing board, and this needs to be worked upon further to make it happen. Now let me turn to two connected pieces, and which are, to my mind, critical for the success of innovative financial instruments. And these two connected pieces are social impact reporting and social audit. These two can substantially enhance the transparency and trust between the issuers and the investors. The technical group set up by SEBI has provided concrete guidance for both the aspects for entities which would choose to list on social stock exchange. So there are recommendations on the minimum disclosure and reporting requirements. So these recommendations were also a part of our working group report, the first report. So this technical group has built on that recommendation. There is a recommendation for creating a social impact scorecard, and also importantly on independent verification of disclosures by social auditors. Some sort of assurance would be required. Social auditors, the group has recommended, will be required to qualify certification courses conducted by NISM. They will also need to impanel with a self-regulatory organization, which is proposed to be under the Institute of Chartered Accountants as a separate sustainability directorate. To my mind, the successful implementation of these recommendations on reporting and audit can be a potential game changer for this sector, for the area of blended finance. Talking about social impact reporting, I am tempted to touch upon another recent, at the risk of exaggerating, if I can call it, path-breaking initiative taken by SEBI, and that is BRSR, the Business Responsibility and Sustainability Report. We already had BRR, but BRSR is something new. Actually, it raises the game in entirety in the area of sustainability disclosure. It contains a comprehensive set of standardized environment and social parameters on which companies shall report their performance. The social related parameters include aspects covering the workforce, value chain, communities, and consumers. So BRSR will enable companies to demonstrate the action taken for the welfare of society through disclosure of social impact assessments of projects, CSR spending in aspirational districts, and beneficiaries of CSR projects. Disclosure on all this will really help. Overall, higher standards of ESG disclosures and transparency, this is our hope, will help in attracting more capital and investments in the country. This report, this notification was released again this month. This month happens to be, a lot of things happening in this space. So the way forward is this will be optional for implementation during this year, but the next financial year onwards, 22-23, it will be mandatory. But SEBI would be really happy if more and more people voluntarily pick this up for implementation without waiting for mandatory requirement to kick in next year. Talking about BRSR, I would also like to thank the Water Resources Group of the World Bank, led by Ms. Kavita Sachwani, in engaging with us. She was very helpful in engaging with us in finalizing water-related disclosures. Finally, I think I should conclude in the interest of time. To sum up, if I can mention this on a philosophical note, life often asks us new questions. and the old knowledge, old manuals, old ways of doing things often fall short. The answers lie in fresh thinking and boldly embracing innovation in our context. So I'm glad that the report on blended finance being released today and the two reports released by SEBI on social stock exchange bring in fresh air, a fresh approach in solving our developmental challenges. It will be interesting to see the final outcomes, which in turn will depend upon successful implementation of the new ideas. All the stakeholders, investors, issuers, regulators, standard setters will have to coordinate and collaborate for achieving positive outcomes. We have a long way to go. Let me end by quoting Robert Frost. You all heard this before. We have promises to keep and miles to go before we speak. Thank you for your attention and patience.
Thank you, Amarjeet ji. Thank you for your reflections and for highlighting the need for greater discourse on innovative financing, the trends that you spoke of around maximizing stakeholder interest versus shareholder value, and also I think some of the points that you mentioned around how is it that development impact bonds, for example, can be scaled and dovetailed into capital markets. I think that is an area that this report does try and address to some extent. And then, just the one point that also stayed with me was on the simplicity of innovative financing instruments, and how is it that, the simpler the instrument, the more appeal it will have for retail investors and for others in an era where, impact washing, SDG washing is becoming so much more pronounced. So thank you, Amarjeet ji. That was a great opening to set the context for this afternoon. Let me now request Meyyappan, who leads two practices at Nishad Desai Associates that we often don't associate with going hand in hand. He leads digital tax and social finance, and he has experience across multiple deals in impact investing and in the innovative finance space. In fact, a number of the deals that are being covered as part of the report are really basis the extensive experience that NDA has had. So Meyyappan, I'll hand over to you for the presentation and overview.
Thanks, Karan. I'm just going to share my screen first. All right. Thanks everyone. Thanks Amarjeet for the introduction, and I think you made several points. Sorry, can you hear me?
Yeah, Meyyappan, there's just a bit of a disturbance and it's a bit crackled.
I apologize for my internet connection. Is this better? I hope.
Meyyappan, if I can suggest, if you turn down the sensitivity of your microphone, we can increase the volume at our end. I think that's what's creating some of the disturbance. Might be one source.
All right, this better now. So apologies for.
No, it's still a bit loud. I would say. I think.
Apologies, everyone.
Meya, you may want to just try and put on a headphone or a speaker or something on. I mean, if that's available.
Let's try that. Is this any better now, or should I?
Well, not.
Sorry, could you confirm now if this is on?
No, I think it's still cracking a bit.
So I think that's my internet connection, and that's not the speaker. I'm really sorry about this.
Okay.
Would you?
The slides, Mayappan and Ramraj can just start us off, perhaps while you just deal with the mic issue.
Sure.
Okay. Okay, Maya, so I'm going to just quickly start off on this, and hopefully you're going to try and fix this as soon as is possible. But yeah, I think, impact of COVID-19, we are all quite clear. There are multiple challenges. I think one is the whole issue of, demand constriction, and, there is a big challenge of inadequate access to traditional sources of finance. MSME cash flows have really been disrupted pretty significantly. I think that's the sort of one piece of the big picture. I think the second one is really around the whole urban migrants and, the loss of income. And, that's again, something which is creating and feeding into the first issue of demand constriction. I think the third issue really is the fact is that the reverse migration has created substantial hardship also for smallholder farmers because of a decline in remittance as well as increased population stress. So what you really have is a situation where sectors across, and we have just given a few examples of the MSME sector, the agriculture sector, have been negatively impacted, and there is clearly a need for substantial long-term capital. We already needed a lot of long-term capital, but I think, the COVID-19 has created even greater need for long-term capital to try and revive, some of the small businesses, livelihoods and jobs. And I think clearly that's the whole mandate that we as a group have come together to think about. What is it that we can do to try and solve, or at least aspire to try and solve for the problem? Can we move on? Let's move to the next slide. Yeah. So quickly, broadly speaking, so essentially in this context, what is really blended finance? So essentially, if I have to quickly summarize, and this is just for the benefit of a large, several people in the audience rather, who may or may not have a full concept of what the whole idea of blended finance or innovative finance that we are talking about is really using philanthropic or concessionary funds to de-risk investments that may be at this point unattractive to commercial capital. So really, when we think about traditional sources of finance, we say, okay, there is a particular sector which can take commercial capital. It goes and lends money at a certain interest rates or puts in equity. Then there is a bunch of people who need grants. So, you give grant capital. The whole idea of blended finance is, can we use this whole area of, bringing blended finance and, bringing commercial capital as well as philanthropic capital together, and essentially use philanthropic capital more in the form of equity to be able to take away some of the risk in some of the areas that commercial capital is struggling to actually take care of. So for example, some of the broad principles of blended finance is it has to be tied to a larger developmental goal, one. Second is blended finance has to crowd in commercial capital. So if I, as a grant provider, put in $1 of grant finance, can I ensure that I am able to attract 3 or 4 rupees of commercial capital in some fashion? Yes, my grant capital maybe, will get a lesser priority, and we can talk about it. But essentially, we should be able to attract a lot more commercial capital. Third is that obviously blended finance has to be tailored to the local context. So we can't take global models and just straight away superimpose it here. And I would say monitoring blended finance for transparency and results is crucial. But I think at the core, blended finance is really about using philanthropic money from a de-risking perspective to be able to bring in commercial capital, to be able to bring in the government, and to bring in other sources of funding, in some fashion, to increase the total amount of capital that is available for long-term recovery of the economy. I think is the broader principle. We can kind of move on. Maya, whenever you're ready, please tell me. You can kind of come in. Not a problem.
Sure. Yeah,
there is now an echo, but the cracking is gone. But I quickly
sorry, is this better now? Can you?
Yeah, I think that's perfect, Maya.
Okay, perfect.
Yeah.
Sorry about that. And thanks a lot, Ramraj, for stepping in and taking over. So I think the point that Ramraj was making, I can add to that by saying that there are 2-3 things as advisors in the space that we have seen also driving a lot of interest in this. And which is also why a year back when we decided to do a report and try to map out what the legal issues were, we focused on blended finance because there were 2-3 drivers. And some of these Amarjeet ji had also alluded to in his speech. So the first one is, of course, that there is not sufficient capital for achieving developmental objectives. And in terms of the big players who do come into this space, when we look at it from a government perspective, I think it was clear that there is not sufficient money to achieve SDG goals. And there could be a lot more capital that can be deployed towards that purpose. From a grant provider, from a traditional charity perspective, I think we are seeing increasingly several reasons why the grant capital is being deployed either for COVID relief or other purposes, where the available amount for in comparison to the kind of developmental goals that we have is considerably smaller. So there is a more pressure to efficiently use grant capital as well. So we do see some amount of commercial interest driving that. And then, of course, as Amarjeet ji said, on ESG, on the private capital side, there also is a significant push to deploy more private capital towards something that has a environmental, social, or impact-oriented goal. So with this, I think more money has been coming into the blended finance space. And as we can see recently, on a global basis, over $152 billion has been deployed through blended finance on various projects. Now, yes, so I think we wanted to very quickly keep the we wanted to quickly deal with 2 very basic examples of blended finance, which we have dealt with in a more detailed manner in the report. At a conceptual level, the first use case of a blended finance structure, which is pretty much you use both philanthropic and for-profit capital and divert it and direct it towards a social goal. We have showcased a traditional loan structure where, let's say, there is an MSME or a farmer who has to get a loan from an NBFC, who typically gets their capital from a debt or equity investor. That would be the typical model for a traditional loan. Now, the advantage in a blended finance solution is you have the grant capital provider or the philanthropic money coming in as a first loss or as a guarantee for the MSME or farmer. Many times, just in this example, not having a collateral could make them unbankable, or they can't really be given a loan. So what a first loss or a guarantee by a philanthropic donor makes is that it reduces the cost of capital and it de-risks the transaction enough for the lenders to actually go ahead and give the loan. Now, why the philanthropic money is able to do this is because there are no return expectations associated with it. And as I said, instead of spending 100 rupees as an expense on a grant, they can actually leverage 500 rupees of commercial capital that goes as a loan. And that actually achieves the same impact objective as the grant would have, except the scope of the impact is a lot larger. If we go to the next slide, the second use case of a blended finance example is a social or a development impact bond. We do have some examples of this in the market in India, where pretty much in a typical contract, what happens is either the government or a grant provider, they enter into a service contract with someone to say, go educate 100 students, and we would like to see 70% of them pass the 10th board exam, for example. But in the outcome funding model, the advantage is that the payment for a particular service provider or outcome is paid only after the achievement of outcomes. So the money doesn't go upfront, it actually goes afterwards once the service provider has proven that the outcome has actually been achieved. Now, this outcome funding model there is a further twist to it, where you can access more capital, where you have a commercial investor come in and say that I will take the risk for a particular project. I will finance it entirely myself. I will appoint the correct service providers to go and educate those children or whatever. And at the end of it, when the outcomes have been achieved, a grant provider or a non-profit entity would pay the risk investor back that amount plus a return amount to justify their involvement in the project. So outcome funding has came from the UK, and it has shown to be very successful in improving the outcomes. And it's the focus of the spending is not just on outputs or other milestones, but on actual outcomes. So these are models in principle which do lead to more efficiency and unlocks different pools of capital. Now, if we go to the next slide, these are some of the very few examples of success stories in blended finance. The most recent one is, of course, the second one on the slide, which is Revive. This is in relation to employment. There was a recent project, and we have a couple of more examples on education and on for COVID relief as well, where over $1 billion has been set aside for these kind of purposes. And these were actually, if you see, a couple of these examples are in the way of rapid response relief fund set up to help people find livelihoods in a post-COVID situation. Just having an enabling framework allowed for private parties to set up these funds and get the funds to people who required it at the fastest possible time. And that sort of showcases the examples of what is possible with an enabling framework that allows for these kind of transactions to be undertaken by private parties. If we go to the next slide, very quickly, setting aside just pointing out a few advantages for both funders and for regulators. From a funder perspective, it de-risks investments, so commercial funders find it easier to get into these kind of transactions, which they would otherwise not consider as viable. It also results in efficient use of capital because, as I said, grant money is leveraged, and it also attracts for-profit capital. Therefore, the total pool of money that is put into these kind of impact-oriented projects is a lot higher. And in terms of effective collaboration, I think there are a lot of benefits in terms of collaborative efforts between the private sector and the nonprofits. And when we have the government in the mix, I think we've seen a lot of that happen in the last year, especially in a COVID relief context. With respect to regulators, I think the main advantages that regulators have is that, yes, state can do a lot of things and has done a lot of relief work, but there is always ability to augment state capacities and enable a more rapid response in situations like this. The entire burden will not just be on the state to deal with situations. They, of course, also have the ability to leverage government capital to bring in more private capital and towards developmental projects. And a lot of this can be unlocked not just necessarily by putting government funding in the role of a philanthropic funder, but rather just by having an enabling framework that allows parties to do where there is already a significant commercial interest today. If we go to the next slide, we have 2-3 structures based on live projects that we tried structuring, and some may actually go live despite a lot of challenges. We have, in the interest of time, I have set one slide here on one of the structures. You can look at the report for the other structures which we have described in detail, which also includes a one on outcome funding. This one is a first-class capital structure using an SVF as a platform. The reason that we have put SVF as a platform here is because in our experience, bespoke transactions have very high costs. So there is a need for a largish common platform where all kinds of outcome funders, risk investors, and other parties can collaborate on a single platform and enable transactions. So SVF has always been, there's been a lot of interest in it from different parties over several years now. Now, in a typical transaction, how would a first loss capital structure work if we were to use the SVF structure? Now, we've tried to simplify this diagram for everyone by, I know it looks like a lot of arrows and a lot of steps, but I'm just going to very quickly take you through it. The arrows have been color-coded to show specifically what are legally not possible or prohibited today. And the yellow arrows are depicting transactions which are unclear or gray, or there is a significant risk element that is perceived by investors, even if as lawyers we say it is doable. And the green arrows are clearly what is doable in the law today. And how this would typically work is you have the green boxes, you have the onshore or offshore risk investors putting in some money into a SVF, which is a pool vehicle that can invest into debt instruments or fund the NBFC below. And that ends up financing farmers and MSME borrowers. So till here, it's pretty straightforward. It's all green. There is no regulatory or legal issue here. Where the challenge comes in a first loss capital structure in this case is we want to unlock for-profit, non-profit money, both in India and in offshore, to play the role of the de-risking party. And to be able to do that, they either have to agree to a first loss or a guarantee structure. Now, when we talk about those transactions or those steps, either an income tax or a CSR law or an FCRA law, and even the SVF regulation sometimes do create challenges in making that a reality. And even if that money comes into the SVF, then there are other SVF regulations which prevent the money from being directly paid out to the onshore or offshore risk investors when there is an actual loss or non-payment by the farmers. So these are the kind of challenges that we face in putting this kind of a structure out with this scale. If we go to the next slide, I think we have set out the key sort of challenges or takeaways, which is that the larger the scale of the platform, the more parties that we deal with, there are more applicable laws. And the problem is that there is a lack of a coherent legal ecosystem that wants to enable these transactions. Each of these laws don't really talk to each other and independently create issues. And when we put all of them together to create a large platform, I think we run into several problems there. And the key takeaway here is, in our report, we have mapped out all of this in detail based on the work that we have done for several clients. And a lot of these issues, legal issues, can be fixed through simple clarifications or comfort given by the respective regulators, while of course some changes may require substantive legislative changes. Very quickly, in the interest of time, again, the 4 big bottlenecks that we have focused on were income tax, CSR, AIF regulations, and FCRA. There are several, these are the big 4 choke points. Of course, there are other laws which also need to be amended, like corporate laws, for instance. I know we don't have a suitable vehicle like a benefit corporation in other jurisdictions. There is scope for changes in other laws, especially also in state regulations that deal with charities and public charitable trusts. But the focus of this paper has been to look at what are the key issues in the major laws that can resolve maybe 60 to 80% of the problems that are faced today. And that's where we narrowed it down on these 4. Now, again, in the interest of time, I think would not want to really get into the individual points that we have set out here. But the broader ask, again, from the industry and from regulators here is, one, in terms of the philanthropy participants, I think it will be good for foundations to be more familiar with newer forms of financing, and especially to invest in capacity building to understand how the instruments work and the risks associated with it. Typically, we've seen foundations are comfortable with any element of financial risk. It's the regulatory risk that really creates a problem. In terms of the commercial capital providers, with ESG and a bigger drive towards investing money in more impactful projects, I think there is increased focus on understanding how in the risk return analysis you factor in impact-oriented returns as well, and how to balance that out along with focusing on traditional financial returns. And in terms of regulators and government, and I think this is the most key part where, and globally, it has been documented by several studies that government support is 30 to 50% of the reason why these structures or this sector flourishes. And it's key that we have the key regulators and government bodies supporting us in this process. Niti Aayog recently came out with a couple of papers actually on the skilling sector, where they are advocating for outcome-focused payments and saying why that would actually be more efficient use of funding. I think and considering the role that Niti Aayog has in terms of coming up with creative solutions to problems, it is probably best maybe if an agency like Niti Aayog were to take the lead in kind of coordinating between several ministries and trying to get this to happen. With respect to SEBI, of course, there has been a lot of good work that has been coming out of SEBI, and in terms of the SSC report or looking at SVF as a key instrument for large-scale impact projects. And I think a lot of the work that we have done on the report can tie into that. There are a couple of specific issues, I think 1 or 2 issues, which if they are resolved in terms of how the money is to be routed back to the investors, I think focusing on those couple of issues may open a lot more doors for funding. In terms of the finance ministry, I think there's not been much action. There are a couple of good amendments that came through in the recent budget, which actually made it easier for non-profits to take loans and clearly account for them as charitable spends when they pay the loan amount or the interest money back. Moves like that are appreciated and really welcome. But fundamentally, there is still the thinking that intermixing of for-profit and non-profit capital is a bad thing. I think that mindset has to change. The world has moved on, and a lot of these social finance transactions are actually globally accepted and their benefits are very well documented. So keeping that in mind, there are a lot of provisions in the Income Tax Act. If at a principle level there is movement, I think there is scope for making many more amendments there. With respect to NCA, yes, I think the recent CSR changes have actually made it easier to do development impact bonds because, for instance, a lot of these projects go on for 3 to 5 years. So carrying forward that CSR money, if it is not unspent in one particular year, because these are all tied to achievement of outcomes. So what if somebody doesn't achieve an outcome? You have to carry it forward to the next year. So parties used to be concerned about that previously, but the recent changes have given a lot of boost, and the focus on impact as opposed to just expenditure, I think is shifting the direction of CSR into a more impactful long-term output-based sort of direction, which is great. And I think in terms of incorporating introducing newer vehicles that would be good for a social enterprise is something that MCA may want to explore. In terms of MHA, of course, their concerns have always been in terms of funding coming into the country for political or regional religious purposes, and that's been significantly impacting relief work in the last year. But there is a lot of work that can be done, any sort of support on a enabling framework towards projects, especially where a lot of the parties are looking to partner with government or government related entities, would definitely enable more money coming into this space and give the track record to show that these projects can work on a large scale and achieve large impact. So with that, I will close. Sorry about the delay, everyone.
Thank you, Maya. For that walkthrough, it was really comprehensive, even though we covered, and focused on one structure in great detail. But for your work, for the team's work, Rahul and others. So let me now just, now that we've got a sense of what the report entails and the sort of red light structure that we were talking about earlier, we can move to the panel discussion part of this afternoon. So let me first start by introducing our moderator, Geeta Goyal. Geeta is, as I'm sure everyone here knows, is the country director of the Michael and Susan Dell Foundation, where she manages the strategy and implementation of the foundation's work in 2 key areas around education and family economic stability. MSDF India, under Geeta's leadership, has been rather active in a number of innovative financing mechanisms that we've seen here in India on pay for success instruments in the education space, on alliances like the Revive Alliance that's also covered in the report. And the foundation has covered over $150 million across over 50 or so active projects in the country. We'll have, so Geeta will be joined by Mr. Amit Chandra, Managing Director at Bain Capital, and he's also known for his work in the not-for-profit space, serves as a trustee of the Tata Trust and a founder board member of Ashoka University, and also on the board of Give India, which of course with the pandemic, has also been mobilizing a lot of resources for immediate COVID relief. We have Mr. Prabhat Pani, Senior Advisor to the Tata Trust and also associated with the SP Jain School of Management, where he's focused and heads a lot of the interventions on the social sector. And finally, Mr. Ajit Pai, who's a distinguished expert at Niti Aayog, heading up economics and finance, and also consultant to the vice chairperson at Niti. So Geeta, I will thank you to each of you for taking the time this afternoon, and Geeta, I'll hand over to you for the panel.
Thank you, Karan. I was just thinking on a Friday afternoon, I have the tough task of following Mayappan's presentation, which was very clear and succinct, and of course the easy task of just asking questions to our distinguished panelists, whom Karan has just introduced. But just so that you get a sense of what's coming in the next few minutes, I would say the focus really is why or the value of blended finance and what is blended finance. I think we've heard the perspective both from Karan and from Mayappan, and the report will also lay out in more detail. But today we have the opportunity to ask people from the philanthropy sector, the private sector, and the government sector to really set out what their view of blended finance is, and especially in the current crisis, are there blended finance instruments which can be set up rapidly and help address the situation that we have today, or even going forward to make our system stronger. And before I go there, I think Karan did say that the Dell Foundation has helped structure and invest in a lot of blended finance instruments. And yes, over the years that we've been in India, we've committed close to 2,000 crores in our work, which spans education, livelihoods, and financial inclusion for the low-income urban families. And I would say, after so much effort, money, and experience with a lot of our grantees and portfolio companies who've just done amazing work, the one lesson, actually maybe three lessons we've learned, is one, just collaboration. I think if we want large-scale impact, silos have to break, whether it's the non-profit or the for-profit or the government. We just, collaborative efforts will definitely lead to much more sustainable, larger scale solutions. And that is the need of the hour. Second, taking risks. I think, we can spend a lot of time theorizing, hypothesizing, and creating structures, but unless we are out there and take the risks, things won't move. And I would say philanthropy does have a special role in that space of, being the first ones off the ground and taking the risk. And the third is measure, measure, and measure. When I think of these three lessons, I would say they really do resonate very well with the blended finance instruments. And that's the reason that if I look at our work, broadly, I would say 70% of our work is in blended finance instruments. And this includes, high risk equity capital in early stage social enterprises, because that gets complemented with mainstream capital at some point of time to help them scale up. Or Karan mentioned, the Revive Alliance, where philanthropic capital can get complemented with CSR capital and then possibly with debt capital, so that philanthropic capital actually takes care of some of the operating expenses and the losses, whereas loan capital and CSR funds can actually go towards creating some sustenance loans for migrant workers, low-income workers. And this Revive Alliance really came together last year and very quickly. So that's another example. And of course, 3 years ago, we invested in the Quality Education Bond, which is the world's largest bond. And that is a development impact bond, and Amarjit ji talked about it. So yes, I mean, at a broad spectrum, I would say 70% of our work falls into blended finance. If I look at it in a very technical way, maybe 1/3 of our work falls into blended finance. But we are strong proponents of saying different instruments, different types of funders need to come together to solve the problems that we are facing today. And I'll talk more about it, but on that note, I did want to, invite our panelists and ask their views on this. And given we've already, we are all sort of learning to react to situations on the ground and not go as per planned way. I was earlier thinking we would, get each of our panelists to spend about 10 minutes and dive deeper into their work in blended finance and their views. But given, how we switched between Ramraj and Meyyappan in the previous slot, I was thinking we could actually go round with each of them. The first question really being, from your perspective, what is the value of blended finance and where have you seen it work well? Just concrete examples of things you've seen, funded, or structured, which have really laid out the impact of blended finance. And Amit, if I can invite you first. And I would say, as you address this question, if you really take both your mainstream investor hat as well as your philanthropic hat, and maybe bias it more towards the investor hat because you do bring in that unique perspective, and say, do you even value these instruments, and in what frame and structures would it excite a commercial investor?
Thank you, Geeta. Thank you, first of all, to UNDP for doing this report and for inviting me here today. I sincerely appreciate the opportunity. Historically, I've never invested in any of these instruments. So let me start with that comment. And the reason, I've never done so is because the approach that we've taken at the foundation is that we've directed all our efforts, both time, importantly, and money, towards problems that we believe markets will not solve. And so, we've historically stayed away from blended finance. And that's not to say that we don't believe that blended finance is important. In fact, we increasingly believe that blended finance is more and more important. And my view actually has started changing a little bit on the topic, and I would say materially so, thanks really to the exercise that Amarjeet ji talked about, the work that he and I had the pleasure of doing under Ishaq Husain's chairmanship for the Social Stock Exchange. That got me to start at least thinking a little bit more and more about the role that blended finance potentially could play in solving some of our problems. And I think the next real big quantum jump, at least in my mind, has been the devastation that COVID has played. Ajit and I have been a part of certain deliberations as well. And that's made me think about a new reality that we all live in. What is that reality? That reality is essentially that tax collections are going to be under incredible pressure. That's going to put a massive squeeze on budgetary allocations. The reality in our country is that we have very high fixed costs. Interest burden is very high. When you take all those things together, it will mean that real spending on anything that's social in nature is going to nosedive in the coming years. So we really need to wake up to that reality and see how we're going to make progress on our SDGs. And Amarjeet pointed out that our ranking is not just abysmal, it's actually falling. Now, in that reality, we need to think about how we're going to approach governance in our country. Now, the question is, where does blended finance fall into this? A key missing framework in our governance over the last 73 years has actually been our approach to M&E and accountability. We've never really asked ourselves how we're going to materially improve these things. Now, where does blended finance come in? I think what we need to really do is demonstrate at scale how, as a nation, we can actually rapidly move social delivery from outlays to outcome framework. Niti Aayog, and I hope Ajit elaborates more eloquently on this, is actually working on frameworks via its arm DMEO on how the government can actually develop frameworks on that. But for the government to do that, the social sector needs to actually build models at scale, at some reasonable scale, to show the art of the possible. And I think this is where, even before COVID came in, the social stock exchange actually has set up a very interesting platform for all of that to get enabled. So, sometimes, serendipity is just incredible. Things have actually come together for blended finance absolutely at the right point of time. And I'm myself beginning to think about what we can do. Later on in the session, I'd actually be happy to talk about one initiative that we are thinking about, which, as and when the social stock exchange is enabled, could be a pioneering initiative to launch on the social stock exchange, which could be pretty meaningful. But I think the time is right to do meaningful things on the social stock exchange for blended finance.
And Amit, just a follow-up question on that. If you take a mainstream investor hat, and in the last 1 year, again, as a foundation, we've worked with a few investors to either provide first loss guarantees. In fact, we almost supported 100 crores in MSME support last year. And I would say more than half of it was through first loss guarantees, so that more capital could be leveraged and gone in. And also, so I mean, that's one example where we worked with mainstream capital. The other has been, we've tried to create interest variations based on impact received, because the investor doesn't care about impact, we do. And it's much cheaper to leverage their dollars and just pay an increment or an incentive for impact achieved. Any thoughts on structures like those and the sustainability of those structures? Again, recognizing that philanthropic capital is limited, but maybe government subsidies can substitute that in future. I don't know, but I would love to hear your views.
No, absolutely. You see, that's exactly the point. These structures are awesome. I mean, if you think about the structure you just talked about for MSMEs, the government has done a similar structure for MSMEs, the ELGC scheme, I think it's called, right? You don't need to give handouts. Handouts, actually, including charity, should always be the last resort. It should go where markets actually, are the last, don't reach. And that's where I think philanthropists really need to step in, because markets cannot always provide the solution. And that's where I think philanthropists need to really step in. Otherwise, we need solutions like exactly the ones you talked about. And if we can demonstrate, I mean, because the government cannot be innovative. Let's face it. There's fear of regulation. There's fear of investigative agencies. All kinds of fears are there. And governments also can't be nimble. So this is where I believe like the scheme you talked about, if we can innovatively, people can come together. It can be foundations. It can be philanthropists. It can be CSR. I was on a committee, to reform CSR. The government, MCA actually put it up. One of the key things we debated on that committee was what should be the purpose of CSR. And everyone, Mr. Injeti Srinivas, a really dynamic IAS officer, was the chair of the committee. The committee was almost unanimous that the role of CSR should not be to replicate what the government does in social spending. We have to be innovative, and we have to take risks which the government cannot take. And we should actually demonstrate the art of the possible so that the government can then go out and do things which it cannot do. Like, for example, if there's a loan loss scheme to be developed for social spending, that should be the role of CSR. It should not be to, go out and Mayappan in his slide had augment government schemes. We should not be augmenting government schemes in my mind. We should actually be, doing things which are completely different from what the government is doing. And I think that is the big opportunity for us. And that's where blended finance can come in. It can do completely innovative things and then go to the government and say that, look, here is a great example. Take it and run with it, scale it up.
Thanks, Amit. And maybe since we are talking about the government, I would actually invite Ajit now. Ajit, I am very uh, tempted to say that blended finance works and it's trying to solve complex problems. And I think some of the challenges that we've seen and Meyapan also outlined are with respect, the complex structures need some flexibility on the regulation so that we can actually create those stacks that meet every pool of capital requirement. But those asks are outlined in the report, and I will not ask you to respond to those. I think the question I would pose to you is really from wearing a government lens. Again, the value of blended. Do you even see the value of blended finance? And are there specific examples or gap areas where you see blended finance could actually step up and support what the government is doing?
Yeah, absolutely. First of all, thank you for inviting me and sharing views on a subject that is very, very dear to me, and also I think is very relevant to the current context. Not just because of the pandemic, but also because of what Amarjeet ji has just pointed out, which is that the need for capital in this country, whether it's development capital, overall capital, is massive. And so the manner in which we use it and how we architect our overall financial architecture to ensure that it is most effective is also very important. To answer your question, I was very, very delighted to hear Amit ji talk about his philanthropic efforts that we have not spoken about before. But what he specifically said is that his philanthropic efforts are focused on where the government doesn't operate and where there's market failure. So the market failure, I think, is what is the key way I look at the value of overall blended finance. Because when you have a look at a country like India, just very quickly to tell you where today our report card is in terms of per capita GDP, which is only one metric, not the all-encompassing one. There are many others, I think, that are far more comprehensive to show where we are. But we are still sub 20% of the world average on a per capita GDP basis. In 1962-63, we were at about 21% of the world average. And using all the different techniques of redistribution of income, we landed up at about 6% in before liberalization in the early 90s. After that, it's been huge progress, almost a tripling from where we were back then. But clearly, China was not very different from us back there, and I'm not advocating the Chinese model. But development in China has been far, far more rapid in whatever mode that we look at. It's a different form of government. But they are right now very close. In fact, I think in 2021 they'll probably be the world average for per capita GDP. So that begs the question that when we look at India, we're not yet a wealthy country. We're not even the world average. We've got to figure out how to be able to use our capital most effectively. And simple redistribution might not be the solution. It would be actually being much more efficient. So I think looking at the approach that was highlighted by you, Geeta, which is that looking at blended finance is one option to get greater leverage. The way the government has been thinking the past 5 years is to find where it has the greatest leverage. So today, blended finance generally implies something when you're mixing the three capitals, right? You're mixing philanthropic capital, you're mixing commercial freely available investor capital, which is looking at risk reward ratios, and you're looking at the government. Wherever either of these two or three blend together, it's blended finance. But today, the meaning has come to mean primarily towards the SDG goals. But you go back a couple of decades, and it was in any area where there was market failure, whether it was a commercial enterprise where there was going to be market failure unless the government intervened, and it did, was called blended finance too, and it happens very often, and we can talk about some examples there, or whether it was a social enterprise. So the government of India in the past 6 years has taken an approach in several areas that would be following the principles of blended finance, except that it's not philanthropic capital involved. It's right now only the private sector and the government involved. And when we move to philanthropic capital, which is very important for us, we'll see what we need to do to help the philanthropic capital get more involved. But good examples of where the government is responded to this excessive program. So very simply to describe what that program is that the government of India has a lot of assets that are underutilized. And for greenfield projects that they were giving out on TOT for infrastructure, whether it's roads, whether it's ports, whether it's any other sort of large public infrastructure project, the cost of capital was excessively high. And the main reason why the cost of capital is excessively high will tie into something, Geeta, you've talked about, and I think Amit has hinted at, but he's been very polite about it. But it is our regulatory and compliance environment. I mean, it is the way our government is structured. You have 3 tiers of government: a central government, a state government, a third tier, which is either a PRI or a ULB, urban local body. The jurisdictions are mixed on almost every item. And we have a regulatory and compliance burden that is one of the biggest sort of, nightmares in the world. Now, cleaning that up is going to take a long time. So there are certain aspects of that we can change, some that we might not want to change. There's a price we pay for having the three-tiered system of government and being a democracy relative to China, and we recognize that. But all the unnecessary stuff, all the compliance and regulatory burden, rather than creating more and more segmentation and fragmentation, I think if you go back to the simple principles and work on that, we can have huge impact. And that's what's happened with the asset monetization program, where it was very simple. What the government said is that these projects, because of the regulatory risk, having a national green tribunal that is very necessary, having judicial intervention, having the judiciary is necessary, but having this, are all unexpected risks that investors don't want to take, because eventually for a neutral investor, it's time and money, and then the risks to that time and money, right? Those are the sort of two broad factors. So the moment the government said that we can take the greenfield projects and the government will take the risk, but all the brownfield and completed projects, stabilized assets, we will give to the people like the big pools of money in the world where the money is available. Not philanthropic money, pension money, all of that. Suddenly we are in business, and we have had an unprecedented growth in the number of roads and infrastructure, all of that India is seeing. Now, when you look at that model, we are trying to apply that to almost every area. You've seen airports going through that model. You've seen ports go through that model. We're trying to apply that model in the railways. We're trying to apply that model in every possible area. So that's blended finance, not in the current definition, which is now moved towards purely the SDG, but the principles are very, very similar. Now, when we look at what the problems the country faces today in terms of where there's market failure, for example, we haven't had this same model right now successful in hospitals. The government is exploring that, it's wrestling with that. But if we roll out hospitals across the country with the government and the private commercial capital combining, you can get to what you call critical mass. Right now, you have clinics that are around, which they're setting them up at, with 5 beds. It's an uneconomical model. Even if you get the model up and running, that 2 or 3 years from now, it won't be operating because it will be a big drain on, on expenditure, revenue expenditure. So what we need to do is make that 5-bed into a 25-30 bed where it's a self-sustaining model. And there's a gap that comes there between what is required and what happens. So those are areas where I think that having expertise that comes in from the outside, because this is all across the country. This is not central government. This is sometimes not even state government. It is the local government. So having expertise that comes in from the outside, that starts looking at, what are these right models? Where does the capital need to lead? And how to harness the various resources? Because the government, as has been pointed out, the various levels don't talk to each other as well as they should, the 3 tiers. Secondly, the incentives might not be fully aligned. So there are places where the third sector, where the philanthropic capital is necessary, because the commercial capital doesn't have time to do the work. They just want to provide the money. Think about that as the big lazy money when it comes to the pension funds, all of that. So that's where we look to someone such as the MSDF to come forward, do the structuring, do the hard work, and put together something which starts making sense for everyone because it starts aligning misaligned interests. So this market failure, the government has also looked at, not necessarily in the philanthropic area, but if you look at viability gap funding for areas where India is subcritical mass in certain industries, you can say that the APIs or pharmaceutical might, sort of fit the bill for philanthropic investors, but the others might not. But things like that are what the government has been doing as an instrument of what you could, what you could call blended finance. And the first loss guarantee scheme that the government has introduced in certain areas to provide similar to you, but at a much larger scale, and we know that the government has scale, is an area that is addressing the same issue for similar outcomes as the MSDF, but at a larger scale. So that's another area where the government is trying to use leverage and giving that guarantee and getting that massive leverage from the markets. So it's a beginning. It's a beginning. There's a lot more that can happen there across multiple sectors that we can talk about. But since I gave you a very long answer to that question, I'll stop now.
Yes, so thank you. That was helpful. And maybe I'll just leave you with a thought and I'll come back to you. But I think you mentioned healthcare and hospitals. But just to bring up another example, we work a lot in education. So yes, we have worked with the Delhi government and also with NITI Aayog. One on trying to experiment with public-private partnership in schools. So again, the experimental funding could come from philanthropy till the model stabilizes and there are some guidelines. And similarly, given our experience with assessments of education outcomes and impact bonds there, we were trying to see if outcome-related funding could actually be pushed through in the education department. So yes, it's and clearly acknowledging that, as I said, the first risk and the measurement can come from philanthropy, but then either the government or the market really needs to step in and take over. And Ajit, I would love for you to respond to that, but I'll come back to it. And also, I know in another panel we had discussed about MSMEs and other forms of supporting them so that they can access low-cost debt. So maybe when I come back to you, I would love to hear from you on those. Prabhat, I can invite you now. Yes, again, you've heard a lot on blended finance, but Tata Trust has also been playing in this field in a variety of different ways, including, supporting the education bond, but several others as well. And you do bring in an academic lens also to this field. So I would, just share your views, both from a practitioner, philanthropist, as well as an academician's perspective on really is blended finance something that one should look at, on a continuous basis? Is it a stopgap? What is the value it provides? And, till when is the value useful? And then it needs to move on.
Sure. Thanks, Geeta. I think the first part, which would answer the last question that you asked, is how long? I don't think the attainment of the SDGs, which itself is a monumental task, is going to mean that everything that needs to be done in the social sector is over. And even if one were to just look at the kind of targets that we have by 2030, and if you look at the range of numbers that are being talked about, I think UNSCAP talks about something like $2.64 trillion being required to meet the SDG goals. And there are other people who talk about numbers which would be similar, maybe slightly larger, slightly lesser. So clearly the requirement of bringing in private funding and commercial capital to make up the blended finance is something which I think is a necessity, certainly for countries like India. And if one were to look at really what has happened, let's pick up the impact bonds. Even though we say that there is a fair amount of work and lots of things are happening in India, if you look at the overall situation, there are something like 208 bonds, impact bonds, which are up and running as we speak, a total of 474 million US across a very wide range of thematic areas: employment, health, education, child and family welfare, homelessness. And even if you were to just look at a country like UK, there are 89 DIBs and SIBs, a very high proportion of SIBs, because the government has now picked it up as a route that they would like to support. 41 have been completed, 39 having met the outcome targets that were set. Now, in this context, I think India is still at a very early stage. The fact that we have only 3 DIBs which are currently in operation, 2 of them in education and 1 of them in the area of health, a fairly small amount of money, just about 6 million raised as of now. Beneficiaries, of course, is much larger in relation to what happens elsewhere in the world, primarily because of the nature of the population that we have. So we are currently covering, I think, about 300,000 people, and should be reaching about 800,000 people by the end of the DIBs. I mean, 1 is over, and when the other 2 also get complete. So clearly the sense one has is that we have a long way to go. It's good that the first SIB, in a sense, at least, has been announced in India, because the Pimpri-Chinchwad Municipal Corporation signed an MOU in the month of January, even though my sense is that given whatever has happened in the last few months, it would obviously take some time before it kind of takes off. The other one, of course, besides Revive, is the health-focused initiative, Samriddh, which has been announced in more recent months. It seems to have gathered a fair amount of traction with, I think, close to about 150 million in grants and loans which are being looked at. And some of it is understandable because it's picked up that space of healthcare and really finding, let's say, flexible financing mechanisms to address various forms of challenges and look at the entire value chain. So manufacturers, suppliers, healthcare providers, and so on and so forth. If this works, and there is no reason why it shouldn't, it's going to start with the first 20,000 public and private hospitals, which are part of the government-approved list, but could well expand to something more. It could well help, garner more steam in providing similar options, which would become available for other sectors and for other players. A quick bit about some of the work that has been done by the Tata Trust. You are, of course, aware about the participation in the Quality Education India DIB as a technical partner, and happy to talk about that a little later. But there are all kinds of small and big initiatives which I think have been used over time. Even if one looks at, let's say, the Swachh Bharat mission, you may recall that there was a fairly large, decent incentive of 12,000 rupees, which was being given once you built the toilet. This was in rural India. But the whole issue was, where would the family actually manage 12,000 rupees to actually build the toilet and then claim the amount from the government, given that there was a fairly complicated process of somebody certifying it, and then you would get the money. So what the trust did was actually used its self-help groups and gave them a revolving credit. And this money was given and then kind of collected back once the beneficiary got the money from the government. And then it went a second time round and a third time round. Now, the only complication there was that once you gave the money to the SHG, it had to remain there because the laws didn't allow that money to come back. So you had to find another use at the end of the Swachh Bharat mission for that money which was given there. And that's where the piece comes in about looking at the regulatory framework for maybe a more, let's say, efficient usage of that money. Similarly, in various livelihoods programs, the trusts have used either NABARD in some cases when it's an agri-based activity, or even some commercial credit from banks like SBI and PNB on some of the fisheries projects. But clearly the sense is that at the moment, the grant money is largely being used to take care of 100% of the requirement, which cannot be met either from the community or from the government. There is clearly the possibility of looking at the kind of mechanisms that we talked about, by which that grant money would be able to crowd in, would be able to get commercial money in. And that is something which can obviously make the rupee stretch a lot more.
Excellent. Thank you, Prabhat. And I was just thinking maybe, especially in the context of blended finance with market capital, so philanthropy and market, I mean, the three roles of philanthropic capital, and we can keep adding to it, is really to catalyze and showcase, or to provide the first risk, or to drive impact. Like the DIBs are a clear structure where we are not really getting too much of commercial capital right now because of the regulations. But at least it is showing, significantly better outcomes and impact on that. So yes, with that, Amit, maybe I'll come back to you in terms of, again, especially in the context of COVID, are there areas where you see blended finance structures could play an important role? And I would say, yes, I mean, COVID is a very here and now, but will stay with us. So maybe, either taking a short-term view or a medium-term view in that would be useful. And as you think about these structures, are there interventions that are needed to unlock more of these structures? Whether it's just knowledge, information, regulations, but maybe just the top few highlights from you.
Yeah, Geeta, I want to again just build a little bit upon what Amarjeet Singh ji kicked off in his opening remarks, when he talked about the social stock exchange. And one of the things that we'll have to really do post, COVID is relook at how we allocate capital very, very closely. Because the fact is that even earlier, we weren't a country which had a lot of capital. And even less so long-term risk and risk capital. Post-COVID, I think that's going to be even less so. And so if we have to deal with the social reality of tens and possibly hundreds of million people pushed below the poverty line, and combine that with the capital allocation problem that he talked about, I think we'll have to do something very, very differently. And that takes us to this whole point about thinking about innovative finance, thinking about productivity of capital. And I think that's where the opportunity lies. Now, one of the areas, obviously, where, COVID has thrown upon a couple of things where we'll have to be very, very imaginative. We will have to be very imaginative in how we think about our cities. You can't but help think about the fact that COVID spread very quickly in urban areas because they were designed very poorly. So is there a role for, blended finance in housing? Because if we had, better, housing for our poor, maybe we could have averted some of the crisis. And the fact is that, the cost of this crisis escalated massively. We paid a massive economic cost just because we had highly, highly densely packed slums. So, should we be thinking very differently about housing and sanitation? And should some of that be things that both the government and philanthropists should be investing in? That's one area. The second, obviously, that all of us are beginning to think about is getting very close attention, at least right now from foundations and philanthropists, is education. And the fact is that even all of us of privilege have realized how far children have got left behind by just a year. It's not 1 year of lack of education. It's a lot more. Anxiety has got built up amongst all of us, many of us on this call, because of staying, indoors in a year, and the damage on our children is a lot more. When you think about the digital divide that people of, without privilege have faced, and you combine all of that, it's just enormous. And we'll have to think very hard about what needs to be done and what role blended finance can play, in that area. So what kind of innovative solutions can be played, can be created, so that we can maybe bring 150 million kids up very quickly, and demonstrate to state governments and other municipal governments that something can be turned around relatively quickly over the next 3 or 4 years. I think there's a great opportunity there. And finally, health. This has not spared rich people. I know of families, really well-connected families, who couldn't get a bed in Delhi and Mumbai. Mumbai less so, Delhi a lot more. Delhi, at least in Mumbai, they could call someone they knew and finally manage. But in Delhi, I know that even that was difficult. In rural India, we know what is happening at this point of time. So what solutions are possible? On the other hand, we know that telemedicine has started working. We have to completely reimagine our health systems. And I think if blended finance has a role to play, it's probably there. What kind of health architecture we need to reestablish? How do we really massively improve the flow of talent? I mean, for a country where, tens of millions of people, this whole demographic dividend that we keep talking about needs to get opportunity. That's got to be one place where, we're going to enable that opportunity. So how do we create that opportunity in an asset-light model? I think blended finance has got to have a role to play there.
Yeah, definitely. And given our focus on education, we are also very sort of cognizant of the fact that as a sector that's really getting left behind in terms of, all the current attention. And while, one can rely on online education to some extent, even beyond the digital divide, the physical space of a school definitely has its own advantages. So yes, and we'll come back with some more thoughts that we've been thinking on it. But, to your point on the health system, Amit, I couldn't agree more. And I think we saw a little bit of that in our work in the States with the education system. So even getting all the data in one place in terms of schools, teachers, students, competencies, that itself brings in so many efficiencies and the right direction. And I'm sure we are headed there. And maybe on that note, again, when it comes to the government, Ajit, you are the focus here. So yes, any thoughts from you? Again, more in the context of, especially in the context of COVID, where you see the government pushing in. I mean, you talked about, the private sector, we talked about some examples on philanthropy, but maybe if there are any specific thoughts, either on the healthcare systems and, some kind of innovative finance there, or on the MSME or agriculture side, because I know you've been thinking about these solutions for some time.
So first on the healthcare side, so the government is faced with many challenges because, as you're aware, Geeta, we've been underinvesting in healthcare for decades. And when you're increasing investment in healthcare, it is not just the hard investment. I also saw a question asking about the third wave of COVID, I think on this Q&A, asking about the third wave of COVID and how is the government preparing for it, right, in terms of the service delivery. So unfortunately, the problem is one which is of, it's not just a capital issue. If we just suddenly triple the number of beds that the country has, it's not going to help if you don't have the doctors and the nurses and the staff. So it's not something that you can take away capital from infrastructure and roads and put it over here and suddenly everything will be okay. That's the way the media talks about it. That's the way a lot of people talk about it, but it's not that. It's clearly not that. So what the government has done in the past 5 to 6 years was been trying to build up that capacity of increasing the number of doctors, of nurses, etc. You had, now, interestingly, there's a central government effort over here, but what is far more important, you've watched 6 AIIMS go to 22 AIIMS, you've watched the medical schools being increased, all of that, but a lot has to happen at the state level and at the base level. And that's where we've got to figure out whether there are innovative schemes that we can do with exactly what you're looking at when you're talking about blended finance, or where you can put together blending between the center, between the state. There are central funds, there are philanthropic funds, but there's also state funds. Now, state and center are not always aligned. It can be 2 different political parties. And you've seen in certain states that forget about, with the center, but even when government changes from one government to another, you can change the capital of a state and leave something midway, right? So there's huge amounts of, politics and political economy involved. So that's where I think when you look at the value that an independent sort of outside capital and structuring comes in, or tying these things together, making use of a central grant, making sure that there's no advertising. You've got to align everybody. That alignment is not something that happens naturally between the center and the state. Now, that's a Niti Aayog mandate. So I'm telling you, cooperative federalism is our third mandate. So we are the policy agency of the government. We are the think tank of the government. So we are supposed to be as independent as possible. And we are the third mandate and a critical mandate where we're trying our level best to figure out models to do, perform that job, is cooperative federalism. Our flavor of that has been competitive federalism. We've been creating all these indices you see to start comparing them, because if people don't know where they are, how is it going to help? But at a fundamental level, that's helped because it's brought some transparency of data. The data quality in India is very poor, but at least you have begun starting getting metrics that you wouldn't get. You have the SDG index that you're probably quite familiar with, so you're going through. So at least we know where we are. You have that report card, and suddenly this district collector or this SDM somewhere knows that he's in the middle or he's last. Otherwise, he didn't know. There was no comparison. So that is the sort of foundational way that we've been operating there. Now, from a healthcare perspective, we know that the central government has increased, if you're looking at something specific like, PSA machines, oxygen machines at district hospitals, 162 approved last October. We are in April entering the second wave, and only 33 of them are installed. So clearly it wasn't the capital was allocated. There's a huge coordination issue. Let's not blame the central government, the state government, the district hospital, but we know that. Now we have increased that from 162 to added another 550 to that. Let's say we have 600, 800, whatever that number is. So that's not the, the capital is not the constraint there. I think it is much more to do with what happens in terms of the logistics, in terms of the manner in which things are planned out, and the cooperation between the various levels of government and the private sector. Now, if the manpower is going to be improving, it's going to take time. It's going to take 5-6 years. So one of the reasons why the states have been, so conservative in the second wave, and big chunks of the country have been locked down, is because despite that first wave, where we thought that the country was ready, we bought some time. We saw these incidents that I think Amit talked about just now in Mumbai and Delhi, which were shocking because it had gone through a first wave and we weren't prepared at all. We have had a 1-year learning curve. We have put all this, but we still came out. I wouldn't give us pass marks, right? I would have failed the Indian system. Let's not call it anybody. I wouldn't give them pass marks for what happened. So then these are the questions I think that we've got to ask, right? So forget about the third wave, which is too close to us. But when you're looking out further, what do we have to do to avoid what happened right now? And a lot of that, I think, is figuring out how we can improve the systems, make sure that the constraints and investments in healthcare are happening in the right areas. And, a large part of the Amarjit ji talked about that 6.2% of GDP investment to, reaching those goals by, by 2030. A large part of that, when we were doing the math, is basically investment in these areas, in healthcare, some in education, but much more in healthcare than I would say in education. And we have got to figure out, in this country, less than 4% of the people pay taxes, less than 4%. So we know that the pool that the government is working with is fairly limited. So when we are looking at that, we know that private participation and the right models, that PPP model that you talked about, has to be designed right. And it has to be a model which includes capital formation within this country as well, not just a spending model. And that investment should be oriented towards capital formation. So that addresses, I think, your question on the healthcare side and what's going on there. On the other two fronts, I think I will only address the first half, which is the MSME and cost of capital, rather than the second bit for paucity of time. I think you're almost out. Or do you want to move on before I address the MSME and the overall cost of capital question?
Actually, why don't you give your 2 bits on the MSME and cost of capital, because it is an area which is of fair interest to the audience also.
So our view when we look at the at what the issue in the cost of capital India is, it's more of a financial architecture issue. So very broadly, when you look at India and you look at what its overall leverage as a country is, the total debt to GDP ratio is one such ratio. Relative to where the world is right now at 370%, we are way lower. Now, our government debt is very high, which is recently risen all the way up to 90%, which raises the cost of capital for the overall country, because our rating is based, as a country, is based on what your sovereign rating is. Everyone is indexed to that. And a large part of our architecture is that the capital comes from the banks. The about 50% to GDP is what the bank advances are. So that creates certain issues, because when the cheapest form of capital, which is the banks out there, is not able to provide that capital, the alternative in a country which has a massive credit gap, the lowest estimate I've seen for that credit gap for MSMEs is about about $500 billion, which is about a fairly significant gap, and that gap is a real gap. So I think it's more of an access to credit issue right now. Even the NBFCs right now, most of what capital the NBFCs are dispersing, a large chunk, if you see the credit from banks to NBFCs, it's exploded, especially after the commercial papers and the bond markets dried up. So that is an area where I think that we've got to look at instruments that are blended finance, not so much from the world of philanthropy, but much more from the government working with those NBFCs in providing a role that MSDF is doing, but at a national scale. Because providing that first loss guarantee on bond issues, for example, at a large scale in a pool area, is going to be something that the government can do, like it's done with an Ayushman Bharat scheme or something. Insurance at that scale is far more dispersed and focused. So we have got to start looking at approaches, that are similar to that, rather than trying to push through the traditional systems of distribution, which would be the banking system, where there's deposits have been growing in double digits right now. No, disintermediation is not happening. Banks don't want to advance that money. The rules for advancing that money are such that only if you have a government scheme or a priority sector is it going out. So it's extremely channeled, too highly regulated, too constrained for sending money through that channel. And that's why the government has to intervene. But trying to use other methods like the NBFCs, try to figure out how to make the bond markets below the AAA and AA sort of start working over there. 95% of the bonds are there. Figuring out how to make, that's where most of our effort should be on the macro side. And that would help the MSME financing probably much more than directly trying to come up with anything specific.
Excellent. Thanks, Ajit. Over to you, Prabhat. Yes, we have 5 minutes. I think if we can hear from you on, again, what are the things that you feel are required from an ecosystem lens to institutionalize this whole, if I can call it, movement around blended finance, like what's missing and where is the momentum needed or what push is needed?
Sure. Thanks, Geeta. So the first part I would think that is very, very essential is really education of all the players involved, so that they understand what the concept of blended finance is all about. I'll give you an example. About 3 or 4 years back, when the early work with regard to smart cities was starting to happen, the Pune Municipal Corporation wanted to raise the first municipal bond, and they got a plus rating, if I recall, and they got something at some 7.59%, and it was seen as something which was dramatic, and this is a municipal corporation which was possibly one of the only ones which was actually balancing its budget. They actually used to collect as much from various taxes and all of that as what they spent. So you can well imagine that if people were going to go that route in terms of raising municipal bonds, what the rates would have been. And when we spoke to some other municipal corporations, everybody just wanted to raise the bonds, and they won't even think of any alternative ways of finance. So my sense is that I think there needs to be a significant amount of education at the level of various functionaries in the government system. And given that smart cities itself is a very large arena of operation, and all of them at some point in time are expected to balance their budgets, I think it would be wonderful if they get to know alternate ways of raising funds and blending in philanthropic money that is required. I think the same thing needs to be done even at the level of philanthropic organizations, CSR organizations, assuming that at some point in time the legal structure would allow all of that, and even NGOs, because finally activities are going to be carried out through the NGOs. So education, I think, is going to be a fairly big piece. I was very delighted that the GROW initiative, GROW, which has been put out recently by Edelgive and supported by many organizations, including Amitji's foundation, is focusing upon developing capacity within NGOs, because I think that is going to be extremely important going forward. The institute that I am attached with, SPJN in Mumbai, that actually runs a postgraduate program in development management, focusing really only on people from NGOs and from CSR organizations and conducting MDPs. And we'd be more than happy to see if there is a role that we can play. And along with other organizations like maybe TIS and IRMA and some other IIMs, look at taking this up in a very big way so that all the relevant stakeholders are given appropriate, let's say, capacity building for them to understand the possibilities that exist. I think the second part of the ecosystem would be to really look at all the other players. Monitoring and evaluation, I mean, impact assessment. Suddenly with the CSR Act now requiring impact assessment to be done, we hear from lots of people that where do we do it, who can do it for us, what is it going to cost, and all of that. If we have to look at instruments like development impact bonds to come in, then clearly the role of data and analytics and measurement, use of evidence becomes extremely important. And they have to be maybe work at two levels. One, finding appropriate agencies to help do that at scale and with multiple interventions happening simultaneously. And second, also getting people within the organizations to understand. So almost like, let's say, what CRISIL and ICRA did in the financial services space, you would need to have equivalent people in this space. I think research and policy papers, and some example of that we saw with the wonderful report that is being published today. And we heard about the work that is being done by SEBI through Amarjit Singh ji. I think there is a need for a lot more work of that nature. And again, it's not as if I'm plugging for the institute that I work with, but there is a Center for Financial Studies that's there at SPJN. It actually works at the intersection of industry and financial organizations, and of course, academia. There is no reason why entities of that nature should not be brought into this whole area, because if you have to make changes, if you have to produce thought papers and get the regulators and others to look at some of the best practices which are appropriate for this country, then it has got to be based upon proper studies and research along those lines. And the last part, of course, would be that we would require audit, legal systems, disclosure. All of this, I think, needs to be brought in. So I would say it would be work at two levels. One is focusing upon getting entities in this space who can take up the work. And second is building capacity across the various players in the value chain, as it were, so that everybody understands how important these pieces are in terms of the long-term direction.
Thank you, Prabhat. And I'm conscious of time. Maybe I'll just take a minute to summarize, and then Karan, you can step in. But I think clearly everybody is seeing value. There are different roles, of philanthropy when it comes to blending with the market, when it comes to going where the market cannot exist, and when it comes to blending with the government. But I guess across all different roles, the need to act fast, the need to act with data, the need to build in systems, and transparency becomes extremely important. And also, I guess, the need to think large scale, especially in the context of blended finance instruments. And all of that definitely needs, ecosystem education, research. Prabhat, great points there. And I do think, to Amit's point, the areas where there can be an immediate focus would be housing, sanitation, and I would really prioritize healthcare. I mean, things would not change overnight, but healthcare, and more so the training of the health staff, the technicians and all that, so that we are ready. And with that, Karan, would you like to come in, or Ramraj?
Geeta, can I have just one intervention, a quick intervention on Amit talking about housing? So, there is a different hat that, I wear also at the Delhi Urban Arts Commission, which I chair. And over there, when you have a look at some of the biggest issues that are facing our cities, it is that in a city like Delhi, about 45% of the inhabitants of this city are living in informal development. So this creates an infrastructure, while it is a voter base for, a government, it creates not just a simple housing issue, but it's an entire urban development issue, or water contamination, whether it's sanitation, whether it's, safety, all of that. So one of the areas which has some of the greatest sort of friction towards government working directly with commercial parties, developers, is this area. It is this redevelopment in our urban cities where the conflicts of interest are considered massive. You've seen experiments in Bombay, you've seen experiments in Delhi and Bangalore. And this is an area where I think blended finance probably has the greatest potential. Because when you're looking at this pooling of several fragmentation of either usurped land or misused land or government land or whatever it is, and combining it to provide some of the more there's an actual economic case that exists. Because when you combine these all, you provide FSI, the floor space index, the builder will make his money. But it's the manner in which it happens, it's the size of parcel, the structuring of this, all of this, which is the biggest challenge, which the government can't do because the system is very often accused of all kinds of things. The private parties can't do coordinating all of that. It's when you have this blended finance model over there that can be actually the single biggest driver of our economy, with money being made by anyone involved, where it's not just the capital, but it's the catalyst that you talked about. So just an idea there.
A very complex problem for to solve.
Just one thing too.
Also an area where yeah, but I mean, the other issue I would add is migrant labor. Yes, and I think a very special thank you to all of you. Karan, Ramraj, over to you. I know Amit needs to leave at 5. So
yes, thank you everyone. If I could just have everyone, keep their videos on. We're just also going to put the link to the report here on the chat for everyone to be able to download. So thank you very much for joining us, Amarjit ji, Amit ji, Prabhat ji, Ajit ji, and of course Geeta could not have thought of a better moderator for this afternoon. Let me just quickly hand over also to Kavita just for a minute, and then we'll close out.
Sure. Thank you, Karan. And so much has been spoken and shared, and so there's not much more to add. I recall hearing in a webinar I attended recently that projects seldom fail, but many are also unable to scale. Of course, there could be a lot of reasons for that, but today I think that together we have taken yet another significant step in this journey to reimagine the use of grant money and make charitable work more impactful and scalable. And as all the speakers and the panelists eloquently asserted, it will continue to require not just collective, but coordinated action with the support of all of you to augment the already ongoing development efforts by the regulator and the government. So we just want to leave you with this message that this is a continuum. It's not the end, it's a means to an end. And we hope to be able to draw up an optimistic and realistic roadmap to work on the asks from the private sector and the government that Meyapan outlined in his presentation and the panel reasserted. So the 2030 Water Resources Group of the World Bank is very enthusiastic to continue to be a part of this journey with the UNDP, the Impact Investors Council, and Nishit Desai Associates, and We will continue to work on the pilots we have initiated in the areas of access to pre-harvest and post-harvest credit and climate resilience, also for smallholder farmers, and many other such initiatives where we can leverage blended finance in the water sector as well, just as so many of you in the audience are working on. So enabling regulations in the areas we have recommended in the report, we believe will go a long way in accelerating seamless flow of capital, both domestic and foreign, into these important sectors. Thank you, Amarjeet ji, and thank you, Mr. Pai, for your presence and participation and your encouragement. I think it means a lot to us to have you by our side and to see SEBI being so receptive and proactive and leading some really path-breaking reforms is indeed heartwarming. It's great to see so many things coming together: the social stock exchange, the BRSR, the social impact reporting, and of course the recommendations in this report. We also look forward to the indispensable value that we believe NITI Aayog can add through outreach and interface with various line ministries, as you alluded, Mr. Pai, to facilitate flow of capital into the development sector. Thank you, Geeta. Thank you, Prabhat, and thank you, Amit, for your insights and for continuing to inspire with your work and contribution to grow and scale investments and impact. And last but not the least, thank you to all of you in the audience. There are so many of you who we are working with so closely on this agenda. It would be I think, a vain endeavor on our part to recount the tremendous insights and inputs that so many of you have provided, which have gone into shaping the recommendations of this report. We seek your continued participation in putting the various pieces of this jigsaw together as we work on co-developing pathways to accelerate large-scale dispersal of capital into the development sector towards a more sustainable, inclusive, and resilient India. Take care, stay safe, and stay well. Thank you very much.
Thank you. Thank you.
Thank you.
Thank you.